Good morning. Today is Tuesday, March 5th, and I'd like to welcome you back to yet another edition of O.B.S Financial Educational Series, Learn from the Tax Masters. Over the last couple of days, we've gone over your pay stubs, T4s, the basic type of income that you're going to report. So I guess next we're going to move on to we're going to talk about some other tax documents. Over the next couple of days, we're going to talk about some students and other things that we need to start knowing about taxes. But today we're going to go to the T4a. So what is a T4a? Well, a T4a reports other types of income that you would receive that are not considered employment income or are not the results of an employer-employee relationship. There's many issuers of T4As. Probably the most two common ones that we're going to see is for those of you who have worked hard for your life and you're now enjoying your glory days or your golden years, as they say, and you were fortunate enough to work for a company that offered a pension, you'll be one of the most common recipients of the T4As. All pensioners receive a T4A. On your T4A, you'll see a couple of boxes being used. Number one would be your income, box 16. Now, if you receive income in box 16 on a T4A, I do want to make sure that you understand that that you can split your income with your spouse based off of that amount. Up to 50% can be used. Now, in all my years of doing taxes, I have yet to find a situation where even if the other spouse works and makes into the six-figure amount, there is still a benefit to splitting some of your pension. So you want to take a look at it, you want to optimize it, figure out the different calculations, because the minute you start receiving pension income, there's tax credits that go along with that help reduce the amount of pension, the amount of tax paid off that pension. So while it may only be $1,000 or $2,000 or $1,500 that's getting split, the amount that is getting split could end up saving you and your spouse or your family some money. The other most common box on a T4A for pensioners would be box 22, and that's the amount of tax that was deducted. Very similar to a T4. If your benefits included a healthcare plan and you had amounts taken off of your pension in order to pay for your healthcare plan, in most cases, you'll see amounts in box 135 of your T4A. That's the amounts that you paid for your extended healthcare and dental plan. Those are deductible as medical expenses. There are some employers that have other arrangements set up, but they don't include the amounts on your box T4A. So if you're paying individually, independently to your insurance provider for your plans, even if it's part of your pension, make sure you get a letter or a receipt at the end of the year for how much you have. And again, that would be reported as medical expenses. Now, the fourth box that pensioners or retirees would normally see on their T4A would be box 119. Now, box 119, again, it has to deal with group benefits, and it's for amounts paid by the employer or by the pension fund, by the union, for life insurance premiums. Now, in most cases, in the past, companies send out a separate T4A for this amount only. You'll see a box coming in $30, $40, $103, whatever the case may be, but that is to be included as income because it is a taxable benefit. Just talking about pension income and everything else, the one other box, and this is if you work for an employer and you paid into a pension plan and you decided to leave the employer after 6 months, a year, year and a half, up to 2 years normally, you would have paid into your pension, but your pension was never vested, which means that it was never vested means it was never made permanent. It's probably the best way to explain it. So in a situation where your investment was never made permanent, you'll get your money, the amount of money that you put into it, you'll get that refunded. Because it was deducted off of your T4 either this year or the previous year or the previous year, it was a tax deduction in box 20 of your T4, then you're going to have to pay tax on the money when you get it. So you would see those amounts in box 18 as a lump sum payment. Other T4As. Okay, co-ops, patronage allocations. For those of you that, especially out Western Canada, around Manitoba, go to your co-op gas stations, co-op building centers, co-op grocery stores, pay things, give them your co-op number. You have a membership. At the end of the year, you get a check. Well, those checks are for what they call patronage allocations, or I like to explain a little bit better is it's a rebate or a refund based off of your purchases. It's not profit sharing. If you only go and buy one thing at co-op, you're going to get reimbursed. You put one tank of gas in a year, you're going to get reimbursed based off of the liters that you put in the tank. So you're really not going to get a check. They're just going to add a little bit to your equity. Now, because of that, if those purchases are made for personal use, the amounts that you receive are not taxable. And, the government's asked the co-ops to put a nice little note in their envelope saying that, if this was for personal amounts, you don't need to use the T4, just write personal use or personal consumption on top of it and hang on to it for your records in case you need it, da-da-da-da-da-da-da. Well, unfortunately, that becomes a bit of a problem because there's another box on there on that on your T4a. So your T4a, I guess, number one, patronage allocations are in box 30. If you receive the check for more than $100, you're also going to have an amount in box 22, income tax deducted. Now, if your rebates over $100, they are required to take withholding tax off. Now, by just throwing away your T4A, if it's personal consumption, if they've taken off 100, 150, and I've actually seen people that have gone through and, for example, built a house, bought all their materials at the co-op building center, and they get a refund of $8,000, $10,000 at the end of the year. Because they're using the building center, they're putting all their fuel in, they're using the gas station or the grocery store, everything's bought at co-op, especially in some of the rural towns. They get a nice, great big refund. Well, if the government's taking 15% off, I have seen it, income tax being withheld as high as $400 or $500 in some cases for clients that is all 100% personal consumption. Well, if you don't use that T4A or if you throw it away, well, you just threw away $400 or $500 because you can claim back the tax that they deducted. So never throw the form away. Hang on to it. Report it. Report the amount of tax deducted. That's it. Report in box 22. And if it was personal, you don't need to include the amounts on your tax return on line. Oh, what is it? Line 130 of your tax return? Yeah, I think that's what it is. Anyways, why do they send them out if it's all personal consumption you don't have to use? Well, because there are people that do use co-ops to make purchases and they're able to deduct those expenses. Most commonly would be at the co-op gas bars, in companies, self-employed individual, employees that are able to deduct vehicle expenses. Well, because they're deducting 100% of what the cost of those fuel receipts are every time that they look at it, the amount of money that they receive as the rebate would have to be added back into their income. So that amount would be in there. Other situations, if you're a self-employed contractor and you buy all your building materials at a co-op building center, or if you own a small restaurant, most commonly right now are the food trucks. If you're buying all your food at a co-op, you're getting a refund at the end of the day. Well, all that food or a majority of that food that was purchased was for business use. You wrote it off. You do have to claim that amount in. You can do a calculation and prorate it for what your personal amounts are based off your personal purchases versus your business-related purchases. So that kind of covers that. And again, if it's taxable, report it on line 130 of your tax return. Now, if we go through the T4A, there's about another 45 boxes that we haven't covered yet. In the interest of keeping you awake and not boring you to death, I'm not going to talk about all 45 of them. I'm going to wrap it up talking about 4 basic other ones that are more common, or wrap everything up here. Number 1, we've talked about benefits a lot the last 2 weeks. If you receive disability insurance, wage loss replacement plans, something along those lines, and it is taxable, the company that paid you, Manulife, Sun Life, Industrial Alliance, any of the benefit providers, if they've paid you disability and it's taxable, then you would receive a wage loss replacement plan with the numbers in box, I believe it's 107. Students receive T4As, and they receive T4As for a ton of different income. Some of it's taxable, some of it's not. Some of it has some deductions built into it. So students' taxes actually can get very complicated, especially when they get bursaries, scholarships, fellowships, awards, research grants, artist grants. There's actually about 10 different boxes on the T4A that deal specifically with students and tuition and grants and everything else they receive. So talk to a specialist. I'll touch base on a couple of these things later on when we talk about students. I actually might be looking at doing that one for tomorrow. But because it is important, when it comes to your students, it gets complicated as to what you can, what you cannot deduct. So if you have students, and then there's transfers to parents for unused amounts and some other things. So if you have students, make sure you see a tax professional. It's more important than you think. Their taxes can be very complicated and do take a special amount of training in order to figure it out. People who are self-employed or that work on special projects may receive T4As. So, most common would be self-employed commissioned people, right? So if you work for a company and they pay you strictly based off of the commissions that you receive, you're not an employee. You're able to do and come and go as you please, do whatever you want to do. You just made an arrangement for getting paid a commission every time you sell their product. They will send out a T4A. Very common in the insurance and the investment industries, but also in general sales altogether. Research work, or if you're getting paid to teach or lecture at certain times and you do not, but it's a one-time off event, or if you're working for a university or hospital and they're paying you to do research, they may not treat you as an employee. You may be required to hire your own employees, hire your own research assistants, pay for your own costs. That being the case, they would report the amounts on box T4A, and you would have to look at filing a statement of business activities, statement of professional activities, or if it's a research grant, research work, you may just have to keep separate track of what you've paid out and report that. So, in most cases, it's easier to do a T2125 because it does explain all of your expenses. Artists and actors that work on special projects. So if you get a phone call, you got a decision for a career change, you want to go and act as an extra on some of the movies that are being shot in your hometown or whatever the case may be. If you're receiving money for sitting around, for doing that, for being an extra, for doing voiceovers, for doing singing, that is all considered, it's all T4A income. And I guess probably any other type of income that you receive where there isn't, where you're self-employed and the company wants to make sure it's deductible, they will include that onto a T4A. And lastly, I guess probably the best thing to think about is a T4A is a tax slip that's issued to you if you earn money or you have income and or deductions when you don't have that employer-employee relationship. And most times that's determined by CRA doing a CPP or an EI ruling. So that kind of touches base on the T4As. Keep an eye on them and remember, hang on to those co-op ones because they're money in the bank. Anyways, we'll talk to you later. Thanks for tuning in. Bye now.